Welcome to a world where financial maneuvers create and shift wealth, where companies change hands and strategies with the stroke of a pen. Today, we delve into the intriguing world of leveraged buyouts, commonly referred to as LBOs. LBOs, in essence, are acquisitions of companies or parts of companies, mainly financed using borrowed money. The acquired company's assets often serve as collateral for the loans. Now, why would anyone do this? Well, the primary reason is to gain control of a company without having to provide all the capital up front. Picture this. You're at an auction and you spot a masterpiece, but you don't have enough cash to purchase it outright. So you borrow money against the value of the masterpiece itself, promising to repay the loan from the future profits the masterpiece will generate. That, in a nutshell, is how a leveraged buyout works. For a real-world example, cast your mind back to the year 2005. The Hospital Corporation of America, or HCA, was the subject of one of the largest LBOs in history. A group of investors, including Bain Capital, KKR, and Merrill Lynch, saw the potential in HCA and decided to make a move. They didn't purchase HCA using only their own money. Instead, they borrowed heavily against HCA's assets. The final price tag? A whopping $21 billion, but only $5 billion of that was their own equity. The rest was financed through debt. The investors believed that the future profits of HCA would not only cover the debt, but also provide a handsome return on their initial investment. And guess what? Their gamble paid off. When HCA went public again in the year 2011, its value had skyrocketed to about $33 billion. The investors not only repaid the debt, but also made a considerable profit. But remember, LBOs are not for the faint of heart. They involve significant risk. If the acquired company's future profits do not cover the debt, the investors stand to lose their initial investment and potentially much more. In summary, a leveraged buyout, or LBO, is an acquisition strategy where investors use borrowed money, backed by the target company's assets, to gain control of that company. They then aim to grow the company and use its profits to repay the debt. The Hospital Corporation of America's LBO in 2005 is a prime example of a successful LBO, where the gamble of the investors paid off handsomely. However, it's crucial to remember that LBOs carry substantial risk. The intricate dance of finance and strategy they involve can lead to either significant profits or substantial losses. But one thing is clear. In the high-stakes world of finance, leveraged buyouts remain an intriguing and potent tool for those daring enough to wield them. And with that, we close the book on leveraged buyouts, at least for now. The world of finance always has another chapter to explore.